We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting. And no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. The Fed finally cuts rates, Wall Street erupts in euphoria, but everywhere else, Europe's stuck in stagflation limbo. Japan is tiptoeing away from decades of stimulus, and China, on the edge of a stall-out. The global picture is fractured, and the tension is rising. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
We're here again to cut through the noise, break down the global market action, and give you the sharp insights you need. And wow, this past week, it really felt like it was all about one thing, a huge policy shift in the U.S. But how that played out globally, no, that's a different story. So let's dive right in. The big headline. The U.S. Federal Reserve finally delivered its first rate cut of the year. A major dovish move, right? The equity markets certainly seem to think so. But what about the bigger picture? I mean, was it just a U.S. celebration, or did the rest of the world get the memo? What was the sort of global reaction?
Not really a unified celebration, no. What we're seeing is actually a pretty fractured global picture. The Fed's move didn't bring everyone together. If anything, it highlighted the differences. You've got this core tension. Pure euphoria in the U.S. markets versus, well, ongoing economic strain almost everywhere else. Wall Street loved the idea of cheaper money, obviously. But then you look at Europe, still wrestling with stubborn inflation structural issues. Japan, actually trying to move away from easy money, finally. And China. China's recovery looks shaky, frankly. They need stimulus, like, now. So our mission here is to really pick apart these regional stories. Why is the U.S. cheering a cut while others are still dealing with high rates or slow growth? And what's really going to drive the next big market move? That's what we need to figure out.
Okay, let's start with the U.S. then, where the parties seem to be. Equities definitely had a good week. S&P 500 up, what, 1.22%?
Yeah, and the NASDAQ, even better, up 2.21%. Tech loves lower rates.
And the Fed did deliver that 25 basis point cut. The vote was 11-1, so pretty broad agreement there. What did that immediately signal to investors? What changed?
Well, the cut itself wasn't a huge surprise. It was mostly priced in, but the signal it sent, that was powerful. Investors immediately started thinking, okay, more cuts are coming. Yeah. The market's now pricing in, I think, 2 more cuts before year end, and that just flips the switch on risk appetite. Money started flowing into riskier assets, especially rate-sensitive ones.
You definitely saw that showing up in small caps, right? The Russell 2000?
Right. Yeah.
Which is super sensitive to borrowing costs. It was the best performer, up over 2%, hit a new record midweek. That's pure optimism about future cuts right there.
It really is. It's a textbook reaction.
And here's where it gets, a bit messy. It wasn't just about the Fed. We also got some pretty strong economic numbers. Retail sales jumped 0.6% in August. That's like triple what people expected. The consumer looks really strong.
Incredibly robust, yeah.
Okay, rate cut, check. Stock surging, check. Strong consumer, check. Why then? Why did the 10-year Treasury yield, the big benchmark, actually climb to 4.13%? That feels like total contradiction. What's going on there?
Yeah, that's the yield paradox, and it's where the real nuance is. You can't just look at the stocks. The bond market, which is always looking further ahead and maybe a bit more skeptical.
Always the skeptical one?
Yeah. They basically looked past the cut itself and zoomed in on Fed Chair Powell's press conference. He delivered the cut, sure, but his tone was still pretty hawkish on inflation. He specifically mentioned core services inflation still being sticky. So bond traders heard that and thought, okay, they cut, but they're not declaring victory on inflation, not by a long shot. They think the Fed might pause again, or that the underlying battle isn't over. That means they're still worried about inflation risks down the road, so they sell bonds and yields go up. It tells you the market thinks the Fed is still, ultimately, prioritizing inflation over just juicing growth.
And if you look under the hood a bit, housing still looks soft, doesn't it? Housing starts slumped. What was it, 8.5% in August?
Yeah, a big drop. Even though builder sentiment sort of stabilized, the actual building activity fell.
So it's a complicated picture in the U.S. Strong consumer, yeah, but housing's feeling the pain from higher rates.
Yeah.
And yields are saying, hold on, inflation isn't dead yet.
Exactly. More nuanced than just the headline rally suggests.
Okay, so if the U.S. is complicated but generally upbeat, let's hop over to Europe. Things seem much more subdued there. The SDOXX 600 was basically flat, down 0.1%. What's weighing on minds over there?
Well, they're really walking a tightrope. On one hand, you have hints of dovishness from their own central banks. They want to help growth. But on the other hand,
Inflation is still sticky.
exactly, sticky inflation and a pretty weak outlook for growth. It's that classic stagflation worry creeping back in.
Is there any good news? Any resilience?
A tiny glimmer, maybe? Eurozone industrial production actually ticked up 0.3%, which reversed a dip in June, so not collapsing. But the core problem remains. Inflation just isn't coming down as fast as it is in the U.S. Central banks there are in a bind, ease too soon, inflation expectations jump, wait too long, you risk crushing an already fragile economy.
And that fragility really comes through in the UK labor market data, doesn't it?
Yeah.
This seems really important. How can you have wage growth speeding up to 4.7%, but payrolls falling for the 7th month straight?
That combination. Yeah, that's possibly the loudest recession alarm we're hearing in Europe right now.
How does that work?
It means employers are shedding jobs or just not hiring. Payrolls shrink. But the workers they keep have leverage, maybe due to shortages in certain skills, and they're demanding and getting higher pay.
So businesses face higher wage costs and shrinking capacity.
Precisely. It's a nasty stagflationary mix, and it really ties the Bank of England's hands.
So how did the central banks, like the BA, respond to all this?
Cautiously. Very cautiously. The Bank of England held rates steady at 4%, but they did offer a small dovish nod by slowing down their quantitative tightening, selling fewer bonds, trying to soothe markets without actually cutting.
In Norway, they actually cut, didn't they?
They did, yeah.
Oh.
Norges Bank cut to 4.0%, their second cut this year. But, and this is crucial, they immediately said they probably won't cut again until 2026.
Wow, 2026.
Right. It shows even the banks that are cutting are terrified of inflation coming back. They're committing to holding steady for a long time. So the takeaway for Europe, growth looks shaky and policy options are really limited.
Okay, let's pivot now to Asia. Totally different stories playing out in Tokyo versus Shanghai. Japan's Nikkei was actually up a bit, 0.6%. What's happening with the Bank of Japan? Are they finally shifting away from decades of easy money?
They are, but incredibly slowly, like tiptoeing. The BOJ surprised markets with something subtle but potentially huge, an early plan to exit their ETF and REIT holdings.
Explain why that's such a big deal.
Well, for years, BOJ was basically buying up huge chunks of the Japanese stock market through these ETFs. They were a massive presence. Starting to unwind that, even just signaling it, is a major psychological shift that says they're finally trying to reduce their footprint, moving towards something resembling, normal monetary policy.
But there are other signs, other hawkish hints?
Definitely. For the first time under the current governor, Ueda, 2 board members actually voted for a rate hike. That's a big change in tone. And with core inflation, excluding food, still at 2.7%, it just reinforces the feeling that a rate hike is probably coming in 2025. The era of zero rates in Japan seems to be ending, but they have to manage it super carefully to avoid spooking markets.
Such a careful dance in Japan. And then China, Shanghai Composite down 1.3%. The recovery there is definitely looking shaky. August data looked pretty bad, right?
Yeah, really disappointing. Retail sales only up 3.4%, industrial output 5.2%, both missed forecasts, and fixed asset investment growth hit a record low. Not good.
Where's the real pain point, though?
It's housing. Still housing. That's the deep structural problem, and where the policy pressure is intense. New home prices fell month on month in literally all 70 cities they track.
All 70. Wow.
Yeah. And sales in big cities like Beijing were down almost 20% year over year. China's kind of stuck.
So the market must be screaming for stimulus.
Oh, yeah. Markets are basically betting on some kind of big stimulus package, think housing support, infrastructure spending, to try and hit that official 5% GDP growth target. But the tension is, Beijing also has other goals like common prosperity and reducing debt. That clashes with the old playbook of just pumping money into property. So the longer they wait to announce something big, the more momentum fades, and that spills over into things like commodity prices globally.
Okay, so we've got the Fed cutting, but with caveats. Europe cautious and fragile, Asia split between Japan normalizing and China needing help. What does this set us up for next week? What are the key things you'll be watching?
Well, next week is really all about the U.S. data again. It's going to test whether that Fed pivot was the right call or maybe a bit premature. Wednesday and Thursday, we're back to housing. New home sales, existing home sales. If those numbers are weak again, it kind of validates the need for rate cuts.
Okay.
Thursday also has the third estimate for Q2 GDP and durable goods orders. Important stuff.
But the main event is Friday, right?
Absolutely. Friday is PCE day, the Personal Consumption Expenditures Price Index. That's the Fed's absolute favorite measure of inflation. It strips out volatile stuff even better than the CPI.
Right, so that's the one they really watch.
That's the one. That number plus the final University of Michigan consumer sentiment reading also on Friday. That's really going to tell us if this week's stock market rally has actual staying power.
And for Europe, what confirms or denies those stagflation risks we talked about?
For Europe, it's all about confidence and sentiment indicators next week. They give you a forward look. Tuesday, we get flash PMIs, the purchasing managers indexes from the UK and Germany. Those measure business activity.
Okay, so if those are bad.
If those are weak, it signals the private sector is contracting, which feeds those stagflation fears. Then Wednesday, Germany's Ifo Business Climate Index, and Thursday, German GfK consumer confidence. Any disappointment there just reinforces the view of a fragile regional economy, probably puts pressure on the euro too.
All right, let's bring it all together. Actionable insights time. Based on everything we've just discussed, what are the top 5 risks that could really shake things up next week? The things investors absolutely need to have on their radar.
Okay, yeah, let's list them out. 5 key risks tied to specific data or policy moves next week. Number 1, U.S. inflation reacceleration. That's the core PCE number on Friday. If it comes in hotter than expected, forget those multiple rate cuts the market priced in this week.
Yields would spike.
Yields would likely jump, and stocks would probably take a hit as people realize Powell's hawkish undertones were serious.
Okay, risk 1, hot PCE. What's number 2?
Number 2, U.S. housing market cracks widen. If we get another round of really weak home sales data on Wednesday or Thursday, it suggests consumer weakness is spreading beyond just housing. That would hit rate-sensitive stocks, hard banks, builders.
Got it. Housing weakness confirmation. Number 3. Europe's stagflation gets real. If those flash PMIs or the German confidence numbers out Tuesday through Thursday disappoint badly, it hammers home that stagflation risk, high costs, low growth, puts the ECB in an even tougher spot.
Okay. Risk 4.
Number 4. China stimulus stays missing. Momentum is fading fast there. If another week goes by with no big concrete stimulus announcement for housing or infrastructure, market sentiment, especially for commodities and emerging markets, is likely to sour quickly.
The waiting game continues. And the last one, number 5.
Number 5, a BOJ policy misstep. The Bank of Japan is clearly signaling a shift, but they're divided. Markets are jumpy. Any unexpected hawkish comment, any clumsy signaling about their ETF exit, it could easily cause sharp moves in the yen and put pressure on Japanese assets. They need to tread carefully.
Okay, a great rundown. So, quick summary. The Fed lit a fire under U.S. stocks this week. Definitely some euphoria there. But digging deeper, the global story is really one of strain, policy dilemmas, and very different paths in Europe and Asia. That sums it up well. The market right now is making a big bet on U.S. disinflation continuing, allowing the Fed to keep easing. But it's fascinating how much hinges on just a couple of U.S. data points next week, especially that PCE number.
Yeah, it really focuses the mind. So here's a final thought for you to chew on this weekend. What happens if that PCE number does come in hot, confirming sticky inflation, while the housing data confirms real weakness in the U.S. economy? Does that global risk appetite just evaporate instantly? Or does the U.S. simply end up looking more like cautious Europe, forcing markets to realize this recovery might not be as smooth as they hoped?
That's the multi-trillion-dollar question, isn't it?
Something to think about. We'll be back next week to break down whatever
Still
happens.
watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.